40-23. Memorize that number, because it is the single most dangerous signal in the entire financial world right now in January 2026. That is the Shiller PE ratio of the stock market. To give you some context on how terrifying that is, the only other time in human history it was this high was in 1999, right before the dot-com crash wiped out 80% of the Nasdaq and destroyed trillions of dollars in wealth overnight. But here's the brutal truth that nobody on CNBC wants to tell you. The economic collapse building in 2026 isn't just going to be similar to the 2008 financial crisis. It is mathematically guaranteed to be worse. Why? Because in 2008, we only had to deal with one major crisis, the residential real estate market. In 2026, we are facing a perfect storm where 4 separate financial disasters are converging simultaneously. I am going to show you exactly what they are when they hit, and what happens to your life savings when they do. But before we look at the data, we have to address the elephant in the room. You are being lied to. Most mainstream economists and major banks are currently predicting no recession for 2026. Deloitte is projecting 1.4% growth. Morgan Stanley is calling for a moderate expansion. Even JP Morgan only puts the recession probability at 35%. If that sounds comforting, remember this. These are the exact same institutions that stood in front of cameras in 2007 and told you that subprime was contained. These are the same experts who said in the year 2000 that the new economy had eliminated the business cycle forever. They have been wrong at every single major turning point in financial history because their models assume the system is stable, but their models do not account for what happens when multiple systems break at the exact same time. This isn't fear-mongering. This is cold, hard mathematics. We are walking into a trap. The narrative of a soft landing is the most dangerous lie ever sold to the American public. While they tell you to stay invested, the smart money is quietly exiting the building. We are about to walk through the 4 crises that are merging right now. Crisis number 1 is the commercial real estate collapse. Crisis number 2 is the greatest stock market bubble in 140 years. Crisis number 3 is the sovereign debt doom loop. And crisis number 4 is the total collapse of the American consumer. Once you see how these 4 pieces connect, you will understand why the crash of 2026 is inevitable. Let's start with the first domino that is already falling, the 1.5 trillion real estate time bomb. Crisis number 1 is the commercial real estate collapse, and the numbers are staggering. In 2026 alone, $936 billion in commercial real estate debt is maturing. When you add the $500 billion that rolled over from last year, we are facing nearly $1.5 trillion in loans that need to be refinanced immediately. Here is the math that breaks the system. These buildings were originally financed back in 2021 when interest rates were near zero. Now, they have to refinance at rates that are double or even triple what they used to be. A building that was paying 3% interest is now looking at 7%. That instantly doubles the debt service payment. But here's the fatal problem. The building is worth significantly less than it was 5 years ago. Office vacancy rates have exploded to 20% nationally. In cities like San Francisco and Austin, vacancy is approaching 30%. This creates a doom loop where the borrower owes more than the building is worth. The monthly payment has doubled, and they cannot sell the property because there are no buyers. So, what happens? The developers are doing the only logical thing. They are handing the keys back to the bank. We are already seeing commercial mortgage-backed securities delinquency rates skyrocket. Over 278 U.S. banks have been identified as critically vulnerable due to concentrated exposure to commercial real estate. In 2008, the banking system collapsed because they loaded up on subprime residential mortgages that went bad. Today, the mechanism is exactly the same, but the asset class has changed. Banks have loaded up on office towers, retail centers, and luxury apartments that are effectively zombie assets. The banking system absorbed roughly $400 billion in losses during the Great Financial Crisis. The losses in this commercial real estate cycle are projected to exceed that number, and this time the banks are far more leveraged. But if the real estate market is a disaster, crisis number 2, the stock market bubble, is a fantasy. As I mentioned, the Shiller PE ratio is at 40, the second highest reading in 140 years of data. The only time it was higher was December 1999. Do you know what happened next? The S&P 500 fell by 50%, and the Nasdaq crashed by 78%. We are also looking at the Buffett Indicator, which compares the total stock market value to GDP. The historical average for a healthy market is somewhere between 80 and 100%. Anything above 160% is considered significantly overvalued. Right now, in 2026, we are sitting at 225%. Warren Buffett himself has warned that ratios approaching 200% mean investors are playing with fire. We are way past fire. We are playing with nuclear waste. The danger is hidden by the Magnificent Seven. Seven massive tech stocks, Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla, now represent over 30% of the entire S&P 500. This is not a diversified market. This is a concentrated bet on AI masquerading as an index fund. The AI boom driving these valuations is a mirror image of the dot-com boom. Yes, the technology is real, just like the internet was real in the 90s. But when you pay 40 times earnings for a stock, you aren't pricing in growth. You are pricing in perfection. And in an economy facing a recession, perfection does not exist. If these 7 stocks correct even slightly, the entire market collapses with them. While the stock market is disconnected from reality, the bond market is screaming about crisis number 3, the debt doom loop. As of this month, the U.S. national debt stands at a staggering $38 trillion. We are adding roughly $2 trillion in new debt every single year, but the terrifying number isn't the total debt. It is the cost to service it. In the fiscal year 2025, the federal government paid over $1 trillion just in interest payments. To put that into perspective, interest on the debt is now the second largest line item in the entire federal budget. It is larger than the entire defense budget and larger than Medicare. That is $1 trillion of tax revenue that isn't building roads, funding schools, or strengthening the military. It is simply vaporizing into thin air to pay for the mistakes of the past. This creates a mathematical death spiral known as the debt doom loop. It works like this. High debt requires high borrowing. To attract lenders, the Treasury has to offer higher interest rates. Higher rates increase the interest expense on the debt, which increases the deficit. To cover the larger deficit, the government has to borrow even more, which drives rates even higher. It is a vicious cycle that feeds on itself until something breaks. The Congressional Budget Office projects interest payments will hit $1.8 trillion annually by 2035, but that assumes interest rates go down. If rates stay high because of inflation, the system breaks much sooner. We are running out of runway. In 2008, the crisis was triggered by private sector debt, mortgages, and credit cards. The crisis of 2026 is being driven by sovereign debt, government borrowing. This is infinitely harder to fix because the entity that normally bails everyone out is the one that is bankrupt. And if the government is broke, the average American is shattered. This brings us to crisis number 4, the consumer breaking point. For years, we have heard that the consumer is strong, but the data proves that the consumer is drowning. Look at the auto loan market. Americans now hold $1.66 trillion in auto loan debt, with an average monthly payment of $748. Subprime auto delinquencies have hit 6.65%, the highest rate since tracking began in 1994. In 2024 alone, 1.73 million vehicles were repossessed. But the scariest statistic is negative equity. 28% of people trading in their cars are underwater, meaning they owe more on the old loan than the car is worth. The average negative equity is nearly $7,000. This is the canary in the coal mine. Economists are terrified of this data because of the payment hierarchy. Historically, the car loan is the very last payment an American household skips. You will stop paying your credit cards and even your mortgage before you stop paying for your car, because you need your car to get to work to earn money. When auto loan delinquencies spike like this, it means the consumer has already exhausted every other option. They have depleted their savings, maxed out their credit cards, and borrowed from family. They are at the absolute end of the line. Subprime borrowers are breaking at rates we haven't seen since the Great Financial Crisis, and when the bottom of the income ladder breaks, the stress moves up quickly. The consumer accounts for 70% of the U.S. economy, and right now, that engine has stalled. Now let me show you how these 4 crises connect, because this is where the nightmare scenario truly begins. Individually, any one of these problems could be managed, but together, they create feedback loops that amplify each other in a way that models cannot predict. It starts with the banks. As commercial real estate losses hit their balance sheets, banks are forced to tighten lending across the board to preserve capital. Tighter lending slows the economy down immediately. When businesses can't get loans, they stop hiring. When unemployment rises even slightly, those subprime auto delinquencies I mentioned earlier turn into full-blown defaults. More defaults mean more bank losses, which leads to even tighter lending. The cycle accelerates downwards, feeding on itself. Simultaneously, if the stock market corrects by just 20 or 30% to return to historical norms, the wealth effect reverses. Consumers who felt rich because their 401k was up suddenly feel poor. They stop spending. Business revenues drop, corporate earnings fall, and the stock market decline becomes self-fulfilling. But here is the critical difference between 2008 and 2026, and it is the reason you need to be terrified. In 2008, the Federal Reserve had unlimited policy ammunition. They could cut interest rates to zero because inflation was non-existent. They could print trillions of dollars through quantitative easing because the national debt was manageable. In 2026, the Fed is trapped. They cannot cut rates to zero again because inflation is still lurking above the 2% target. If they cut rates too fast, inflation explodes, destroying the dollar. If they print money to bail out the banks, they risk a currency crisis. The Federal Reserve is currently stuck between fighting inflation and preventing a depression. They cannot do both. In 2008, we had a deflationary crash, which is easy to fix with a money printer. We are staring down the barrel of an inflationary recession, or stagflation, where the economy crashes but prices keep going up. This renders the Fed's toolbox useless. Now, I know what you are thinking. I can hear the objections already. But the economy is resilient. GDP is positive. Unemployment is low. Let me destroy that argument right now. GDP was positive in 2007 too. Unemployment was near record lows in 2007. The stock market hit an all-time high in October 2007. The economy looked perfectly fine until the day it didn't. Recessions are only visible in hindsight. By the time the official data confirms a recession, you are already 6 months into it and have lost your job. The indicators I just showed you, the Shiller PE, the delinquency rates, the debt maturity wall, are forward-looking. They are telling you what is coming, not what is already here. Another objection I hear constantly is, banks are stronger now. Regulations are tighter. That is a half-truth. Banks have more capital for the risks regulators anticipated, which was another housing crash. They do not have capital for a concentrated commercial real estate collapse at this scale. Regulations always fight the last war. The next crisis always finds the gap in the armor. And right now, that gap is sized at $1.5 trillion. We are watching a slow-motion train wreck where the conductors, the Fed and the Treasury, are arguing over who should hit the brakes, while the passengers are still celebrating in the dining car. So, facing this mathematical certainty, what do you actually do? Panic is not a strategy, but preparation is. If you want to survive the turmoil of 2026, you need to execute a 6-step survival protocol immediately. Step 1. Stress test your portfolio. Look at your investments and ask yourself, if the market drops 40% tomorrow, will I be ruined? If the answer is yes, you need to reduce your exposure right now, not after the crash happens. Step 2 is building cash reserves. In a credit crunch, liquidity is king. The people who had cash in 2008 didn't just survive. They bought assets at generational lows and became wealthy. Aim for 6 to 12 months of living expenses in liquid cash or short-term treasuries. This is your war chest. Step 3. Reduce exposure to rate-sensitive assets. This means getting out of long-duration bonds, highly leveraged companies, and anything that breaks when interest rates stay higher for longer. Step 4 is geographical diversification. The U.S. market is trading at a massive premium compared to the rest of the world. International markets are currently trading at valuations that are roughly half of the U.S. level. When the U.S. corrects, capital will flow elsewhere. Don't have all your eggs in the dollar basket. Step 5. Own hard assets. Gold hit record highs in 2025 for a reason. Central banks around the world are buying gold at the fastest pace in decades because they are quietly diversifying away from the U.S. dollar. If the central banks are protecting themselves, maybe you should too. Step 6. Pay attention to the signals, not the headlines. Watch the CMBS delinquency rates. Watch the auto loan defaults. Watch the yield curve. When these indicators deteriorate, the timeline accelerates. We are watching a historical pattern play out in real time. Every major financial crisis follows the exact same sequence: excess, euphoria, exhaustion, collapse, and reset. We saw it in 1929, 2000, and 2008. The names change, the technology changes, but the pattern never does. In the 1920s, it was stocks on margin. In 2008, it was subprime mortgages. In 2026, it is AI stocks trading at 40 times earnings, commercial real estate refinancing at double rates, and a government drowning in $38 trillion of debt. We are currently in the exhaustion phase. The cracks are appearing, the delinquencies are ticking up, and the experts are still yelling soft landing. But the prudent investor knows that the soft landing is a myth. You do not have to time the exact moment of the collapse. You just have to be positioned so that when it happens, you are not destroyed. You want to be the one holding the assets that transfer from weak hands to strong hands. The bill for 20 years of easy money is finally coming due, and 2026 is the year the check arrives. The only question left is whether you will be ready to pay it, or if it will be paid with your wealth. In the next video, I am going to break down exactly which asset classes performed best during the 2008 crash, what the specific crash playbook looks like for 2026, and the exact moves you need to make before the correction arrives. Because by the time the headlines confirm the crisis, the opportunity to prepare has already passed. History doesn't repeat, but right now it is rhyming remarkably well with 2007. Make sure you are subscribed so you do not miss the breakdown. But wait, check out this next story.